Joining us now is DoubleLine Capital Deputy CIO Jeffrey Sherman. It is true that the financial hurricane, and Diamond has been warning about the bond market for a while. He used to be worried about QT and the tightening of the balance sheet. How do you take a message like this?
Well, ultimately, it's going to be signaled through how auctions go. That's, I think, part of what people have been looking at. And there's a big 30-year auction coming up in 2 weeks' time. But ultimately, it's the responsiveness of the rates markets to fiscal and market behaviors. And so what we've seen is for administration that was really focused on Doge and talking about cutting meaningful costs of the government, with this one big beautiful bill, all of a sudden what we've actually seen is an increase expected in the deficit. And so the bond market hasn't really been very keen on it, but it also hasn't caused a massive disruption. And if you think back to what people kind of refer to as the Liz Truss moment in markets was back in the fall of 22, where the bond market in the UK revolted against the policies that are being projected by their fiscal authorities. And so I think what Mr. Diamond is referring to in this case is something where there's going to be some negative consequences in a reaction function through the bond market, which potentially could change the way our policymakers think about enacting the debt burden on the U.S. population.
But what about for you guys at DoubleLine? The tariffs and the beautiful bill and the higher deficit, does any of it make U.S. bonds, treasuries less attractive for you guys right now?
Well, I think what you see here is that there's a part of the curve that most of us have really been avoiding, underweighting, or in some cases outright shorting, and that is the long bond or the back end of the Treasury market curve. And you've seen this during even some of the rallies that we've experienced during April and the volatility we saw through April and early May, where the back end of the curve did not have the same response mechanism that historically it has. And some people have used it as a harbinger of negativity and things to come going forward, because again, if that back end of the curve isn't responding as that safe haven asset, then potentially, it signals some form of duress. That said, this is not just in the US. We've noticed this in international markets as well. Japanese JGBs, the Japanese government bond on the long end of the curve, has struggled as of late as well. So maybe what you're seeing is investor preferences to not want to lend to a lot of these sovereign entities, although we've all been these bastions of safety during crisis on the longer part of the curve. That said, Sarah, it still makes part of the Treasury market interesting. If you look at the belly of the curve, what we refer to as something like the 5 to 10-year part of the curve, we're still using treasuries, those areas, to balance out risk, and it allows us to really take some of these other credit risks that we want to take in today's market to build these kind of more stable-like portfolios.
I do wonder, Jeffrey, how you're thinking about Japan, the long end of Japan, as a sort of catalyst for global events. How much should viewers be paying attention to their auctions and the BOJ's policy direction?
Well, I mean, Japan is one of the larger debtors in the world. Obviously, we have that crown today as the largest debtor country. But what you've seen is really a sharp move. And I think what you've heard over the last decade or so is that Japanese yields can never rise. Doesn't that sound familiar, Carl? Well, it's something that we've heard in the U.S. as well, right? And so what you find is these trends where people say never. There's an old trading adage that say, well, that's probably about to happen as soon as you start hearing everyone say never. So I think it's important to watch, but you can't just look at the U.S. in a vacuum. And if you rewind the clock about, to the middle of April, we had the same discussion where the entire Treasury curve went up about 50 basis points or 0.5% throughout over the course of one trading week. Well, what was the rhetoric around that? Well, it's the debt, it's the fiscal side. But if you go back 2 weeks earlier, that's exactly where we're trading. So I think a lot of these are narratives out there. But what's going to really take is it's going to be one of these policies. It's going to be behavior through Congress, one of these bills where the bond market absolutely says no. And that's when the day of reckoning is. I don't think it's this month. I don't probably think it's maybe this year, but obviously everybody's warning these bells. And so I think you have to watch the global markets. You have to watch, capital flow. And a lot of it is being attributed to the policies of this administration today.
But it does sound like you're saying the bond market will sort of clear its throat and that policymakers will be forced to adjust.
Well, I mean, as Americans and taxpayers, we all hope that, right? We don't want to see this alarming trend of printing roughly $2 trillion a year. It's a path that's untenable over the long run. but it doesn't mean that the bond market is going to revolt overnight. And so, again, it's about capital, it's about flow of trade. And those things are also under attack today as well, where we're really changing the orthodoxy of global trade. And so, again, there's alarms. We've been talking about this for a couple of years. In fact, we've been talking about it for over a decade. The twin deficits matter. And so ultimately, it takes a lot longer for these things to show up. But it's one of those things that'll happen very slowly. And then one day, the markets will reject these ideas. But again, I don't expect it to happen overnight. And in the interim, if you're worried about this, you can still buy short-dated bonds out there. You can buy short-dated securities from the U.S. government that there's not a very high likelihood of default in the next 1 or 2 years, and you still get paid a meaningful amount of risk, and you don't get a lot of pickup from extending out and loaning to these governments for 30 years. So although there's a lot of alarms out there, sometimes as an investor, you've got to clear your head, look through the noise, and try to find things that are easy to analyze, where you can predict more stability of cash flows. And you can see that in a lot of short-dated bonds today.
Well, one thing that doesn't fit that category is easy to predict is the dollar, which has lost 9% of its value, DXY, against other major trading partners. Do you continue to bet against the dollar in this kind of environment if you're worried about U.S. debt?
Yeah, it's something we've been really talking about at DoubleLine for a while now. And we definitely think over the short to medium term that the dollar does trade down. And it happens to be one of these relief valves. If you look at kind of measures of purchasing power parity and thinking about the dollar and on a trade weighted basket, the dollar has been overvalued for many years now. And a lot of that is because, once again, Sarah, it's capital flight. The U.S. has been this place to invest. It's not just our capital markets, rule of law, but just think about ultimately the stock market we've had. We have some of the world beating stocks, or have had, over the last decade or so. And so that attracts capital. That leads to a stronger dollar. And I think when you hear from the administration, when you hear from the Treasury Secretary, they ultimately do want a weaker dollar through the cycle, because it helps absorb some of these policies as well. So all in all, I think that the trend will ultimately be down in the dollar. You may see some short-term deviations, but it is time for investors to start looking abroad and looking at ways of diversifying out against the dollar. And again, another asset you've seen that's done extremely well that exhibits its characteristic is also gold. And we've noticed that gold continues to ratchet up. It ratchets up in every currency. And you've noticed central banks around the world continue to have very strong demand for that. So that also augurs for a weaker dollar as well.
You guys increasing gold exposure over there?
Well, we don't run in our bond portfolios, obviously, but gold is something that we've liked for a long period of time, and we continue to recommend it for our clients. Again, in fixed income portfolios, gold does not belong there, but in general, as an allocator, we do agree with gold allocations.
Okay, Jeff, thank you. Good to get your take.
Yeah, thanks, Sarah and Carl. Thank you.
And your analysis, as always, Jeffrey Sherman of DoubleLine.